Warren Buffett, who's often called the Oracle of Omaha, has shared a bunch of investment ideas that have become really famous in the finance world. He's got a ton of experience and a track record that's hard to beat, and his advice gives some really smart tips about how to succeed with investing. So let's take a closer look at the top 5 investment principles he follows. These principles have been a big part of his amazing journey, and they're still valuable for both people who know a lot about investing and those who are just starting out in the market. Number 1. Focus on quality companies. According to Warren Buffett's investment philosophy, a top-notch company has certain key traits that help it succeed in the long run. Such a company is known for being financially strong, having a history of making money consistently, and having positive cash flow. On top of that, a quality company has a proven history of success, showing that it can make profits and pay dividends over a long time. What makes these companies stand out is that they have an edge over their competitors in their industries. This could be a unique product or service, a strong brand, or a loyal and growing customer base. What really matters to Buffett is how trustworthy and honest the company's leaders are. He thinks it's crucial that the people in charge have these qualities. By sticking to these principles and focusing on great companies, Buffett wants to lower the chances of things going wrong while increasing his potential for success. His approach doesn't just help him avoid short-term problems, but it also helps him find businesses that are set up for continued growth and success in the long term. To give you an idea, some of the companies Buffett has invested in include big names like Coca-Cola, which is known worldwide for its strong brand and loyal customers, and American Express, a well-established financial company with a long list of achievements and a dedicated customer base. Another example is Wells Fargo, a respected bank and financial services company that lines up with Buffett's preference for being financially strong and consistently profitable. These examples show how Buffett's focus on great companies has led to his impressive investment portfolio, earning him substantial profits over many years. Number 2. Look for undervalued companies. One of the key principles in value investing, which is all about finding great deals in the stock market, according to Warren Buffett, is to look for companies that are undervalued. He sees an undervalued company as one whose business is stronger than what its stock price suggests. It's trading for less than it's actually worth. The core of his idea is that these kinds of companies have the potential to do really well in the stock market for a long time. Buffett is very careful when he decides if a company is undervalued or not. He checks out how strong the company's finances are, especially how healthy its balance sheet is, and if it's making more money than it's spending. He also wants to see if a company has something special that sets it apart from the competition, like a unique product, loyal customers, or special patents. And he pays a lot of attention to how good the company's management team is. A big part of Buffett's approach is looking for companies that are selling for less than they're really worth. This way, there's some extra protection in case the investment doesn't go as planned. He calls this extra value a margin of safety, and it's a crucial part of value investing. This principle is like the foundation that helps identify companies that could do better in the stock market compared to others over a long time. For people who want to be smart investors, there are some practical ways to find these hidden opportunities. Doing really thorough research is super important. This means digging deep into a company's financial reports, figuring out how it stacks up against competitors, and understanding how well the management can lead the company. It's also important to be patient. Finding companies that are really undervalued takes time. And when the stock market isn't doing well, it's key not to freak out and sell everything in a rush. Buffett's way of investing is all about thinking long-term, which means staying calm and thoughtful even when the market is bouncing around. Number 3. Diversify your portfolio. Diversification is like spreading out your investments across different things like stocks, bonds, and real estate. It's a smart way to lower the risk of losing money. Warren Buffett, who's a big fan of diversification, puts it well: it's like a shield against not knowing everything about specific investments. There are some really good reasons why diversification is important. First off, it helps protect you from big losses. If one thing you invested in goes down, the other things you've invested in might go up and balance it out. Also, diversification helps you make the most money over a long time. When you're invested in different areas, you can take advantage of growth in lots of different parts of the market. It's tough to have a perfectly diversified portfolio, but knowing that there's always some risk in investing is key. Even so, diversification can help lower the chances of things going wrong and make it more likely for you to reach your financial goals. Here are some practical tips for diversifying your investments. Put your money into different kinds of things like stocks, bonds, real estate, and cash. Also, try to spread your investments across different industries. This way, if one industry has problems, it won't hurt your whole portfolio. And think about investing in different countries too. So if one country's economy isn't doing well, it won't hurt all of your investments. It's also a good idea to check on your investments regularly and adjust them if needed. Buffett's advice really captures the idea of diversification. It's not some magic trick to make sure you always make money, but it's a smart way to lower your risks. His saying, "Own a little bit of a lot of good things," really gets to the point. If you really understand your investments well, you might not see diversification's effects as much. But in reality, diversification is a smart part of investing that helps protect you from unexpected problems while you work towards your financial goals. Number 4. Avoid market speculation. Warren Buffett is not a fan of trying to make quick money by guessing how the stock market will move. He believes that consistently getting those predictions right is nearly impossible, and thinks that kind of investing is really risky. Buffett's way of doing things is all about investing in companies that he understands and believes in. He's all about buying stocks of these companies and holding onto them for a long time, even when the market goes up and down. This strategy of avoiding market speculation has been key to his incredible long-term success, making him one of the richest people in the world. There are plenty of reasons why Buffett isn't a fan of market speculation. First, trying to figure out what the market will do next is really tough. Speculating is like trying to predict something unpredictable. And this way of investing comes with a lot of risk. The ups and downs of the market can mess up your finances. Emotions also play a big role. When people speculate, they sometimes make quick decisions based on how they feel, not what makes sense. Plus, this kind of investing can be expensive because you often have to pay fees to experts. And if you're not right about the market, you can lose a lot of money. Number 5. Be patient. This is one of the most important investment principles taught by Warren Buffett. He believes that it is important to stay invested for the long term, even if the market experiences short-term volatility. He has said, the stock market is a device for transferring money from the impatient to the patient. There are several reasons why patience is important in investing. First, the stock market is cyclical, and prices will go up and down over time. If you sell your investments when the market is down, you will lock in your losses. Second, it takes time for good companies to grow and generate profits. If you sell your investments too soon, you may miss out on the long-term gains. Buffett has said that he prefers to buy a wonderful company at a fair price rather than a fair company at a wonderful price. This means that he is willing to pay a premium for a company that he believes has a strong business model and a long-term growth runway. He is also willing to wait for the market to recognize the value of these companies. If you are patient in your investing, you are more likely to achieve your financial goals. The stock market is a long-term investment, and it is important to stay invested for the long haul. Warren Buffett's investment principles are like a really smart guide in the always-changing world of money stuff. If you want to invest and do well, these principles aren't just rules. They're a way of thinking that helps you make good choices and build up your money over time. When you put these ideas together, you'll be better at dealing with investing, understand things more clearly, and have a better shot at reaching your money goals in the long run. Thanks for watching. I hope you found this video helpful. If you have any questions, please leave them in the comments below,